They are buying, and they're not buying their gold to turn around and sell it. They're buying their gold to hold it in reserve to provide backing for their own currency, backing that they can no longer really have with the U.S. dollar or U.S. treasuries, given the likely decline in the value of the dollar and treasuries. And so they are divesting. And so this is going to continue, but the investor interest, I think, is going to continue to pick up in gold and silver. So I don't think the highs that were established last week and earlier this week, those are not the highs. Those are just a temporary high. I would be surprised if we didn't take those highs out before the end of the year. We could easily move quite a bit higher than those highs. You know, we're not getting a lot of economic news because of the government shutdown. We do get an FOMC meeting next week that could be a catalyst for another move up in the price of gold. You know, the Fed is expected to cut rates yet again. And that is despite, I think the big story continues to be the volatility in the precious metals market. You know, when I recorded my last Peter Schiff Show podcast, which was Wednesday of last week, when I recorded it, gold closed above 4,200, which was a record high, and silver closed, I think, just above 53. That was on Wednesday last week. Now, following that podcast, gold and silver went on to make new highs both on Thursday and on Friday. And I think by early Friday morning, gold had topped out at about 4,375. So I added about another $175 to where it closed on that Wednesday. And silver actually got above 54. It almost hit 54 and a half. It got to like 54.40. Then there was a sharp intraday reversal that started early on Friday morning that saw gold drop about $180 from its peak. Silver dropped about $2.50, and gold ended the week at about 52.50, and silver at about 51.75. So silver was a little lower than it was when I did the Wednesday podcast. Gold still managed to close higher, but the volatility increased dramatically this week, starting on Monday, when there was a big rally in gold, about $130. I think it closed up better than 100, but I think on the high, gold was up about $130 on Monday, and it actually took out the Friday high.
The breakout highs didn't hold. A sharp reversal began early Friday, peeling back much of the week's advance. Gold tumbled around $180 from its peak. Silver shed $2 to $3. By week's close, gold landed near 4,110, and silver settled just above 48.50 cents. This correction marked a loss of approximately 6% for gold and 11% for silver from their highs. Such swift drawdowns underscore how volatile markets can unspool when momentum reverses. In the crucible of late-cycle rallies, it's often the steep drops that define natural market rhythm.
Gold got to, I think, 4,378 and change. Silver didn't quite make it back to its Thursday high. It had a rally, but it didn't, make a new high. And then on Tuesday, we got the big dump. Gold dropped over $300, 6.5% or so one day. Silver tanked by more than $3. And then on Wednesday, we got some follow-through selling, and gold went all the way down to 4,000 and about 16, something like that. Never made it back below 4,000. Got close, and then it bounced back. And gold closed this week, I think, about 4,110. And silver closed the week just above $48.50. Now, yes, we've had a pullback in both gold and silver. They're now in correction territory. Corrections are very normal in a bull market. Gold is now off about 6.4% from its record high, and silver is off about 11% from its record high. But number one, I think the most significant aspect of the gold correction is that we didn't correct from 4,000. We corrected to 4,000, meaning that the correction started well above 4,000. It's not like we ran into resistance at 4,000, which is what a lot of people would expect at a big round number like that. I mean, typically, psychologically, you get resistance. We had it at $2,000 gold. We had it at $3,000 gold, though not quite as much as we had at 2,000. But a lot of people would have expected that 4,000 to be some type of resistance that, could cause a pullback, and it may take a little while for the market to muscle through 4,000. Instead, we went through it like a hot knife through butter.
One telling feature of this correction, the pullback began well above $4,000 gold rather than retreating from that round figure. That suggests $4,000 may now be viewed as a new foundational floor, not a ceiling. Historically, big round numbers act as resistance, $2,000, $3,000, but gold sliced through $4,000 with ease. While a retest below that level is possible, many analysts expect such dips to be brief flushes rather than sustained breakdowns. In bull markets, corrections often serve to shake out weaker hands before the next leg higher.
Yes, we had a correction, but we fell down to 4,000. 4,000 now looks like the floor for the price of silver. Now, instead of being emboldened by that, because if 4,000 is the new floor for gold, that is great news for the gold mining companies. But you wouldn't know that by looking at what happened to those stocks. The GDX is now down 14.5% from its high last week, and the GDXJ is down 15.5%, and pretty much every silver stock is in a bear market, right, down more than 20%, even though silver is at 48.5, which is a very high price for silver. And the fact that it was able to get through 50 all the way up almost to 55, I think should be encouraging news for silver stock buyers, because it shows that 50 isn't the ceiling anymore. We went through 50. And yes, we're back below it now, but I doubt we'll stay below it for long. Now, getting back, though, to gold and 4,000, I think 4,000 is the new 3,000. And if you recall, when we got above $3,000 gold, we did dip below it a couple of times, but we didn't stay below it very long. It really was the floor. The same thing is probably going to happen with 4,000. Now, I wouldn't be surprised if the market went back below 4,000, especially since it came so close this week at 4,016. Now, maybe that was the low. Maybe this is the end of the correction. But it's also very possible that that's not the low, that the market retests that number and maybe goes a little lower than that in order to shake out some of the speculators who may be, buying it now and putting some stops below that low, or maybe below 4,000, hoping that it won't go down there.
Intriguingly, though gold and silver held relatively firm, mining equities painted a different picture. GDX and GDXJ fell around 14 to 15% from recent highs, and many silver miners plunged over 20%. The disconnect highlights that the equities often lag or amplify underlying metal moves. Silver's penetration above $50 despite the pullback offers encouragement to silver stock buyers. The ceiling seems shattered, but equities remain vulnerable to leverage, sentiment, and sector rotation, factors exaggerated in volatile periods.
And trying to get, kind of a low-risk trade where I'm buying gold at 4,100, or maybe they got in a little lower, and I'll get out if it gets below 4,000 or something like that. So there could be some people trying to do that, and, they may get stopped out. Then again, they may not. I don't know, but I don't even care, because I think that if we do go back below 4,000, it's only going to be very briefly, and mainly probably just to flush out those stops. And then the market will come back up. So I think we're headed a lot higher. I think the fact that gold went above 4,000 is a very bullish sign. But what's also very bullish to me is how the media, the financial media in particular, is covering gold's rally, and more important, its decline, because they're treating it like this is the end of some kind of speculative mania. In fact, I was watching on CNBC today, and they reported some news that came out from the inflows to GLD. And there were very substantial inflows finally into GLD over the last, 4 months. And that contrasts sharply with the earlier part of the year and all of last year, where we had massive outflows out of GLD. Now, the way they covered it was, this probably shows you that it's the top of a mania because the investors were chasing gold at the highs, as if we've seen the highs.
Media commentary has shifted, even subtly, to frame gold's pullback as evidence of speculative excess, treating inflows as if they confirm a top. Yet historically, headlines don't mark turning points. They reflect hindsight. Meanwhile, gold ETFs have recently experienced renewed inflows, reversing the prior exodus that had dampened sentiment. This suggests institutional and retail interest is reawakening. Central banks, notably, continue deliberate accumulation of gold reserves, signaling confidence in the metal's role as a non-dollar hedge. Those steady long-term bids contrast with the fickle narrative tone of financial news.
We haven't seen the highs, but according to CNBC, maybe we have, because the investors got suckered into the market and bought the highs. Now, that's very different than the way they covered news last year, when we had huge inflows into Bitcoin ETFs. They didn't hold that out as evidence of the end of a mania, of the individual investor being dumb enough to buy the highs of Bitcoin. The way they covered that was as a positive. They said, well, this just shows that interest in Bitcoin is spreading, right? Now you have more investor interest in Bitcoin, and so it's a good thing. And so money going into Bitcoin ETFs was a positive for Bitcoin, but somehow it's a negative for gold. Now, I think that, yes, it could be a very short-term negative in that we got a correction, right? A bunch of people rushed in, and now we get a correction. And that's probably the last couple of weeks, not the last 4 months, because it wasn't until very recently that gold started rising at an accelerated pace. But I do think that the fact that we finally have some inflows into gold ETFs and that they are significant, to me, does indicate that investors are finally getting interested in gold. Now, they're not interested enough, and there's not enough of them who have gotten interested. But now, after having no interest whatsoever, they're finally starting to recognize that they should buy gold. And I think that that is a good sign, because I don't think that the money that came into ETFs in the last few months is done. That now that gold has pulled back from 43 and change back to 4,100, that whatever interest was prompted is now gone. No, I think that's the tip of the iceberg. We have a lot of money that's going to be following up. Now, yes, there may have been some short-term leverage speculators that got burned because they came in late and they got surprised by a big correction. That's possible.
This recent pullback is arguably a healthy reset, not a trend shift. Analysts note that metal markets have staged rare 9-week winning streaks, something traditionally followed by consolidation. Fresh volatility is expected, especially with the U.S. Federal Reserve meeting looming and rate cuts anticipated. If the $4,000 zone holds, the stage is set for a resumed uptrend. In the longer term, structural undercurrents, persistent inflation, central bank buying, industrial silver demand, and diversification away from the U.S. dollar remain broadly supportive for precious metals into the year ahead.
But all of this is normal in a bull market. And as I've been pointing out, the biggest moves in any bull market, and this is not just for gold, but in general, when you're in a bull market, the biggest moves are down. Just like in a bear market, the biggest moves are up. And that's because the market is trying to fool people into thinking that either the bull market is over or the bear market is over. And in the case of gold, it's a bull market, and these sharp corrections are designed to scare out the weaker players people who may have just come into the market more recently and just kind of get rid of them, get rid of the the dead weight, the excess baggage before we move up to new highs. But the media acts like, oh, this is the top, right? Get out. If this was the top, nobody would know. I mean, that's how tops are generally made, or bottoms. Like, you don't really realize that you're at the top until you're a long way down, right? The markets, they don't ring a bell at the top or the bottom. And so you don't get this big drop that says, aha, the gold bull market is over. No, these big drops like that are a sign that the bull market is alive and well. It just has this correction. And of course, the market was getting overbought. Of course, not overowned. Overbought is a technical term because very few investors own gold. Gold ownership among institutional investors and retail investors is historically low. That's why a lot more money is going to come in. But again, what's also very significant is that the central bank buying is not even close to ending. They are ongoing buyers. They are buying for a reason. They need to increase their gold reserves. They need to decrease their US dollar reserves. And so this is going to happen regardless of the price of gold, right? They are buying, and they're not buying their gold to turn around and sell it. They're buying their gold to hold it in reserve to provide backing for their own currency, backing that they can no longer really have with the US dollar or US treasuries, given the likely decline in the value of the dollar and treasuries. And so they are divesting. And so this is going to continue, but the investor interest, I think, is going to continue to pick up in gold and silver. So I don't think the highs that were established last week and earlier this week, those are not the highs. Those are just a temporary high. I would be surprised if we didn't take those highs out before the end of the year. We could easily move quite a bit higher than those highs. We're not getting a lot of economic news because of the government shutdown. We do get an FOMC meeting next week that could be a catalyst for another move up in the price of gold. The Fed is expected to cut rates yet again. And that is despite